For more on the markets, Tracie McMillion, Wells Fargo head of global asset allocation strategy, and Matt Lockridge, head of U.S. value and PM of Westwood Quality Value Fund. Great to see you both, although it is a very difficult day on the market. Matt, let me get your reaction. Why was the market so surprised by the words of Jerome Powell today?
Sure. No, you're absolutely right. Today was all about the Fed. And as we discussed internally here, we did feel that Jay's conference today was on the hawkish side. When he's using language such as the labor market is clearly out of balance, that to us says that they will continue raising rates until either inflation is squarely under control or they see significant deterioration in the labor market. And so when you think of long-term full employment as roughly 5% unemployed, and we're at 3.5% today, we're likely going to have to see unemployment well above 5% before they flinch and take their foot off the brake with further rate increases.
And Tracie, it's hard to believe. I mean, just last week, some people were talking about a Fed pivot, and now we look at the markets, look at the Dow down 1,000 points right now. And we did hear that Powell talking about this taking some time to bring these prices down, this price stability, and using the tools forcefully. Some very hawkish words there. What are some of the questions your clients have for you right now?
Yeah, so some of the questions that we're getting right now are mostly around, if there is a recession, and that is our call, what type of recession are we going to be experiencing? Is it going to be something akin to what we saw in 2008, 2009? Or is this more of an inventory correction type recession? And, our response to that is that we do not think it will be as severe as what we saw in 2008, 2009, that it probably is more of an inventory correction here. But Powell did not mince words today, and he concisely told the market what it did not want to hear.
Matt, Tracie sees a recession by this year. Do you?
There are definitely cross currents. We see the economy decelerating. And in that type of environment, to us, it's not a buy the whole market. You have to be very selective on how you're allocating capital. So it really is company fundamentals, company specifics that are going to drive returns. And at Westwood, we are investors. We're not traders. So we're looking out 3 to 5 years. And we really focus at the intersection of quality and value. By quality, we're talking about companies that are generating free cash flow, that have high returns on invested capital, that have conservative balance sheets, but with something misunderstood that provides the opportunity for excess returns going forward. So we continue to see a number of attractive opportunities as we look out the next 3 to 5 years, specifically in the consumer areas, consumer discretionary, consumer staples, a lot of high quality businesses with that asymmetry in the reward to risk that we're looking for.
And Tracie, even though we've really seen second quarter earnings not terrible, but it's that forward guidance that's really been letting them down. What do you think this adds in terms of fuel to the fire?
Yeah, I think that what we heard today was that growth is too strong. It's got to come down, and that the labor market also is too strong, and it needs to cool down as well. So that's the direction that the Fed is heading. And so what that means for earnings is that likely we're going to have to see some cuts to Q3 earnings expectations and Q4 earnings expectations because there's going to be some hit to revenue from this more aggressive Fed action.
Matt, we talked with Phil Orlando early in the program who says he sees a new bottom in the 3,600 range. What are your thoughts?
Well, again, we really like to focus on company specifics. And again, it's not really a buy the whole market. We want to find those businesses with the quality characteristics I referenced earlier when there's something mispriced. So, for example, in the consumer space, Home Depot is a name that's down 25% or so year to date with some really strong secular tailwinds. It's clearly being priced as if it's fully exposed to new home sales. But the thing you have to remember about Home Depot is it's very much more exposed to existing homes and investment in the home. And to us, that has long-term tailwinds as the consumer becomes much more home-centric, if you will, than before the pandemic. Home Depot's also made some really important investments over the last few years on the pro side of their business, on e-commerce. these are secular drivers of their growth going forward. So with a company that has underperformed the market year to date, obviously a high quality company with conservative balance sheet, very high returns on capital, a nice dividend currently of 2.5% that they've grown over the last 5 years by 17% annually. So for those investors that really are concerned with inflation, this is a very nice opportunity for capital appreciation and income that will grow each year through the form of dividends.
And Tracie, what do you see as attractive in this environment, knowing now that this is still going to be a rate rising environment, at least for the short term?
We do think that it is probably going to be a rate rising environment in the nearer term. And so what we're doing is we're going up in quality, and whether that's in equities or in fixed income, it's moving up towards those asset classes that we think are more defensive. So U.S. over international, large caps and mid caps over small caps within fixed income, moving some money out of high yield and into investment grade. And we continue to like commodities here. We think that commodities probably still have some upside potential.
Okay, got to leave it there on a busy day. Tracie McMillion and Matt Lockridge, thank you both. Have a great weekend.